Hey everybody, Joshua Phillips here with Churchill Mortgage. It is May 31st. Man, we are on the precipice of summer. June starts tomorrow. So, hey, listen, my apologies. I wasn't able to get a video out last week. I was out of town and wasn't able to put together a video. So, let's do this market update today and we'll try to cover the last 2 weeks. Again, today is May 31st. So, let's take a look here at these charts. So what you're looking at, if this is your first time viewing it, these are mortgage-backed security charts where mortgage rates derive their values, and these are Japanese candlesticks. All you really need to know to read this chart is a couple things. Green is good for rates, red is bad, and the higher the price is, the better rates are doing, and of course the lower the price is, the worse rates are doing. Now, all I can really say about the last couple weeks is that the roller coaster continues. We had this nice run up through the first part of May where pricing was getting better. We saw mortgage rates improve probably about 0.25% over the first part of May. But then we kind of hit the peak and we fell back down. So what we've seen in the last 2 weeks is mortgage rates getting a little bit worse. And then here the last Thursday and Friday, yesterday and today, we've seen things come back a little bit. And we're kind of in the middle of the range of where we've been the last couple months. I mean, it's not great, not terrible as well. Let me see if we can pull down here to a 6-month chart just to get a little more perspective. Let's see kind of what's happening so far this year. So again, we saw mortgage rate improve through the end of the year. We kind of hit our best levels of this year around January 1. And since then, we've kind of fallen off, as we talked about. It's ups and downs. But rates from the beginning of the year are probably at least a quarter, and they've probably been 0.5% off from where we were at the start of the year. As we've continued to kind of struggle. Now, why are we struggling? It's all to do with, say it with me, inflation. So, in fact, today, the favorite report for the Fed came out. Let's pull it up here from the PCE report. So this was a headline on CNBC today. The Fed's preferred inflation measure rose 0.2% in April as expected. Now that term, what we want to see is better than expected. When we ever get to the point where we start to see better than expected, that's when we're going to probably see rates hopefully start to slowly fall. But we saw as expected. Better than worse than expected, but kind of a neutral thing. And I guess the kind of calm the markets down a little bit, and we did see that turnaround yesterday and today with what's happening in mortgage rates. So we're still seeing inflation sitting around 2.8% in this report. They're still wanting to get to 2%, and all the Fed chairs are saying, hey, we want to see things get a little bit better before we start talking about cutting interest rates. And I've been watching and listening to a lot of reports, and while nobody knows what's going to happen, we hope that rates will slowly decline in the second half of the year. We still may not be much better than 7% by the end of the year. Who knows? If we're lucky in the upper sixes, if we're really lucky, maybe we would see the mid sixes. So I think it's going to be a very slow improvement with interest rates. So as always, if you'd like to work on a pre-approval, I'm here to help you. If you'd like to talk about your specific situation, you'd like to talk about specific rates for your situation, more than happy to have that conversation. Hope you have a great day, great weekend, and let me know how I can help. Take care.